Welcome to this edition of The Money Maze, the podcast for South African retail investors who want to stop feeling like they're drowning in jargon and start navigating the markets like someone who actually knows what they're doing. I'm your host Jay, and today we're diving headfirst into one of the most misunderstood and most important parts of investing: risk. Not vibes, not I have a good feeling, but actual measurable risk. We'll unpack beta, your share's drama rating, we'll revisit volatility, but this time with a bit of more feeling, and we'll explore defensive versus cyclical stocks. Because sometimes you want fireworks, and sometimes you just want your portfolio to stop giving you chest pains. So let's get into this. Think of beta as your stock's emotional response to whatever the market is doing. It measures how closely a share price moves in relation to the overall market, usually benchmarked against something like the JSE Top 40. A beta of 1 means the share moves in lockstep with the market. A beta higher than 1, you're on the back of a rodeo bull. A beta lower than 1, well, you're riding a sleepy donkey. So let's say the market rises 10%. A stock with a beta of 1.3 might go up 13%. If the market drops 10%, well, that stock should plummet with 13%. It's important to understand that beta doesn't mean good or bad. It simply tells you how sensitive that stock is to broader market movements. A high beta can mean high potential returns and high potential pain. Here are some examples. Tech shares, even local fintechs, tend to have higher betas because investor expectations are sky high. Defensive utility type stocks like Telkom or REITs with stable tenants usually have lower betas. So what does this matter? Because when the market panics, say over a bad GDP print, a power crisis, or a Moody's downgrade, high beta stocks swing hard. And if you're not emotionally or financially ready for that, you'll panic sell or make panic moves, and panic moves costs money. Now let's revisit volatility. We first spoke about volatility, I think around episode 2, where we covered what it looks like on a graph, lots of jagged edges and price jumps. But today, let's humanize it a bit more. Volatility is the heartbeat of a share's price. Fast, erratic, up, down, that's high volatility. Slow and steady, well, that's low volatility. Now, when you combine volatility with beta, you get the full picture. A high beta, high volatility stock is like a caffeinated squirrel. It's moving fast and reacting wildly to everything. A low beta, low volatility stock, that's your pensioner at Pick n Pay. Moves slowly, complains a bit, but keep things steady. Volatility isn't just about charts, it's about how you react. Let's say you buy a share that's historically volatile. It often jumps and drops by 5% a day. If you check your app daily and every drop sends you into a panic spiral, maybe this isn't the share for you. Or maybe, and I say this with love, you the volatile one, not the stock. Now, let's get into the good stuff, defensive versus cyclical stocks. This isn't complicated, it's just a matter of how a company's profit respond to the economy. Cyclical stocks ride the economic wave. When people have money, they thrive. When people tighten their belts, these companies feel it fast. Think retailers of non-essentials like Mr. Price Home, the Foschini Group, airlines, hotels, restaurants, construction and automotive. You don't buy a new couch, a holiday, or a bakkie if you're not sure your job is secure. Defensive stocks, on the other hand, sell the stuff you have to buy, no matter what. Think food producers, Tiger Brands, RCL Foods, grocery chains, ShopRite, Spar, Woolies, healthcare, Aspen, Dis-Chem, utility services for telcos, MultiChoice, Vodacom. These stocks are often more boring, less sexy, fewer 20% jump days, but they show up every day and even when the market is moody or the world's on fire. In a balanced portfolio, these two work together. Cyclicals give you growth when the economy is buzzing. Defensive holds the line when the wheels come off. Smart investing isn't picking one. It's picking a mix that suits your stage of life, your goals, and your nerves. So, Strategy Snapshot. What do you actually do with this info? First, check your own portfolio. Pull it up now if you can. Ask, am I heavy on high beta, high volatility shares? That's okay. But are you emotionally built for it? Let's be honest. If a red 12% drop makes you want to scream into a pillow, maybe shift your weighting. If you've got 15 years to retirement and are chasing long-term growth, you can stomach more risk, sure, but it must be calculated. Secondly, get familiar with sector trends. Tech, mining and luxury goods, more cyclical, higher beta, higher risk. Consumer staples, utilities, health, more defensive, lower beta, more stable. Third, if this feels overwhelming, don't stress. ETFs like Satrix Divi or Ashburton Top 40 blend a mix of both. Some lean growthy, some lean stable. If you're new, they're a good way to spread your risk without needing 3 spreadsheets and a caffeine addiction. So let's do a recap of your Stokvel starter pack of stock lingo for this volume 9. Here's what we tackled today. Beta tells you how much a stock mirrors or exaggerates market moves. Higher beta, more reactive. Volatility tells you how erratic the price is. It's not direction, it's the emotional rhythm of the stock. Defensive versus cyclical is about how companies perform based on where we are in the economic cycle. And if you remember nothing else, know this: risk isn't the enemy. Not knowing what kind of risk you're holding, well, that's the real danger. And that's it for episode 9 of The Money Maze. If your heart rate's down and your understanding of risk is up, then I've done my job. Just remember, none of this is financial advice. I'm not a financial advisor. I'm just a guy with a mic, a portfolio, and sometimes an unhealthy love for spreadsheets. Please speak to someone licensed. And I'll catch you next time in episode 10, because your portfolio deserves more than just vibes. Till then, may your shares rise and your nerves stay steady.